All right, guys, so today we're going to be talking about the top 5 indicators that we use for fundamental analysis, right? So these are fundamental data releases that you will see come out on a monthly basis on the economic calendar. So there are a lot of traders that like to use forexfactory.com. I have my screen open here. Trading economics is by far and miles and miles ahead of Forex Factory. So this is where I recommend you guys do your fundamental, not research, but look at the calendar, right? So there's something I want to say before we get started. The fundamental calendar isn't everything, right? A lot of traders believe that fundamental analysis, either looking at the news, okay, I got a big old TV right here playing Bloomberg, or going to Forex Factory and avoiding the news releases. That's not fundamental analysis. That's not fundamental. That's not doing any kind of fundamental assessment as to what is happening in the market. It's just data, and the news is the news is the news, as we all can understand that, right? So, fundamental analysis is your search to try to understand intrinsic value in a particular asset, right? So when you do fundamental analysis, you're trying to understand what is the value of this asset, and the reason you need fundamentals is because if you simply just have the price of an asset, then you aren't going to be what's considered smart money. Okay, so I'm pulling open TradingView here, and I'm going to pull open let's say this NZD/USD. Actually, let's just go to the US dollar, the US dollar index. Okay, so again, fundamental analysis is understanding why the US dollar, what fundamental catalyst has driven the US dollar sell side in such a massive way. This is our US dollar on a daily. You guys can see here the US dollar on a weekly, massive sell side slide post COVID. Why did that happen? Fundamental analysis is the assessment process of understanding the catalyst that drove market sell side. Technicals is just a visual representation of that. So you have to have fundamentals, because without fundamentals you have no context. Okay, so we're going to be talking a lot about that in a later video and on many other series and segments that we produce here. So make sure you guys are subscribed. But today, I want to talk about what comes out on the economic calendar. Since so many traders put the economic calendar on a pedestal, I'm like, okay, let's make some content about the economic calendar. But I can't just make content about the economic calendar without mentioning that one piece there. All right, so we're going to start with unemployment. Now, this isn't in any order, by the way. Okay. The weight of these different indicators can change depending on the circumstances and depending on how low or above the market meets or beats the expectation. All right. So let's say there was a world where our unemployment expectation was somewhere around, hey, unemployment should come in at 5.8%. You guys can see right now our actual unemployment is 6.0. Let's say it came in at 6.10, 6.0 is 6.10. Let's say it came in at 6.8, right? 1% deviated from the expected, that is going to give you a price move. Now, if it comes in at 5.9 and the expected was 5.8, again, you're not going to get as critical of a price move. So even the news releases themselves have variables inside of them, but you need to understand your unemployment rate. Unemployment rate obviously is something that is very, very serious amongst all economies. Your average unemployment rate or your median unemployment rate where you want to be is around 4%. And that's generally speaking amongst all economies, 4% is where they want to be. Now, of course, we dipped down pretty far before COVID and got as low as 3.6%. I think that's the low we hit off on, which was a record. As you guys can see, we haven't been that low since the 1930s, okay? So it's been a long time since we hit the low there of unemployment, but as you guys can see, since COVID, we skyrocketed, and now we're floating somewhere around 6%. We did pull back quite dramatically from where we were before, but it is still a while to go until we get back down to those previous lows. So unemployment here in the US at 6%, a very important economic indicator. Okay, so next, non-farm payroll. Everyone knows how important non-farm payroll is. Non-farm payroll has actually lost its significance over time. So back in 2012, 13, 14, 15, okay, I was trading FX back then. I started making video content about Forex in 2015. I've been in the game a long time. Guys, NFP used to move markets insanely. NFP used to have an insane move on these markets. And so what's quite interesting is if we pull over, let's go to NFP here real quick, non-farm payroll numbers. Our non-farm payroll numbers have been obviously really bad. Even the last print that we had for non-farm payroll here in April was 266,000 jobs added back into the economy. If we pull back here and let's look at what we saw last year, you guys will see this massive dip. We were losing a lot of jobs here in the US. Okay, so obviously there was a resurgence. A lot of people are skeptical of these numbers. How did that pullback happen so fast? People are still on unemployment, and it's May 2021. All right, so very doubtful we saw this many people come back into the workforce. So the numbers could be a little bit off, but non-farm payroll basically gives you an idea as to how many jobs have been added or subtracted into the economy on a month-by-month basis. But it says non-farm, so they don't take into account the agricultural industry in the aspect of farming, right? How many farmers are losing or not losing or coming into the workforce, because it's hard to account for those numbers. Okay, so non-farm payroll, it's an important indicator. Remember, its importance increases depending on the significance of the deviation from the expected number. Okay, so if our non-farm payroll was, let's say again, let's head back to that print and let's see what that expected was. So we see here where we at 2021, boom, boom, boom. So we have May. All right, so our April, let's just take a look at our April here. So the consensus was that we were going to add 978,000 jobs back into the labor market. Okay, previously we added 777. The actual for last month, April, was 266K. Okay, so the numbers came in a lot lower than expected, and you did see a slight price move based on that number that came out. This comes out every Friday, every first Friday of the month. Okay, the first Friday of the month, you're going to get a non-farm payroll number that comes out. You did see a slight price move because that number didn't come out so bad on the S&P 500. Many market participants were a little bit weary and a little bit freaked out because of it. All right, so let's take a look here. Let's go to our S&P SPY. All right, and then let's go to last Friday. Boom, there you go. You can see it. Massive sell-off. We've had a slight recovery. Markets have filled the gap, but that was such a large deviation on the NFP that we ended up getting a pretty substantial price move here on our SPY because that NFP number printed so negatively. And I'm sure there was another catalyst that day as well that maybe gave markets a little bit of a scare. But NFP came in and hit pretty hard when that happened. All right, so let's keep moving forward. A third economic indicator out of the 5 that you guys need to be paying attention to is GDP, obviously, gross domestic product, okay? How much is our economy producing on a monthly, and oftentimes this number comes out on a quarterly basis, all right? And so obviously if your GDP is increasing, there is a lot of productivity happening in the economy. You're having an expanding economy, and they're looking at a couple of different sectors. I wanna make a video just on GDP alone, so make sure you guys sub to make sure that you guys can find that video later on. But basically agriculture, right? Consumer staples, technology, all right? Mining. I mean, there's so many different manufacturing. There's different categories that the economists are looking out for to see the growth and the reported earnings from different publicly listed companies. Okay, PMI helps out with this number a bit. PMI, this is a bonus economic indicator. PMI is Purchasers Managers Index. Okay, so this gives you an idea as to how much inventory different manufacturing companies are going to be purchasing for the next month or the next quarter. I'll post all the descriptions of what we mentioned today in the comment section, sorry, in the description below. All right, so GDP, an important indicator. You want to see a GDP growth rate somewhere around 2 to 3%. Now, on occasion, you can have a pretty expansive and fast growing economy, and sometimes we've seen this GDP growth rate as high as 6%. All right, and so here we do annual growth rate here for GDP. You guys can see where were we at? 3%, 3%, 2%, 2%, right? If we pull back a little bit during the expansion phase, right, you guys can see when markets were recovering in 08, we had a real solid boost here, and we were somewhat meandering again around that 2-3% number. We hit off on 4% back in 2015, and then obviously since COVID, we've had a hard time having any real recovery production-wise in the real economy. There's so much dissolution, right? The economy and the S&P is at all-time highs, yet what hasn't recovered to the same capacity as unemployment, what hasn't recovered to the same capacity as CPI, we're gonna be talking about that in a second, is GDP. Okay, so that's where market participants are looking. The market is based off of optimism right now, not off of literal book value of what the economy is doing, and there needs to be an alignment at some point, or we will see this S&P turn back around, and that's from a fundamental perspective. Okay, so by the way, we do a fundamental boot camp. If If you want to learn more about fundamentals and how we trade fundamentals, we take a lot of fundamental trades on a weekly basis. The link for that is inside of the bio below. Very important you guys get up on your game for fundamentals. A lot of traders strictly trade technicals, and they miss out on traders understanding what real value is in markets, and it makes it extremely hard to be profitable if you don't understand value, if you don't know where value is in markets. All right, so the link for that is in the bio, and make sure you're just overall doing your research as well. Okay, so next up, that's GDP. I want to talk a little bit about the interest rates. All right, so you guys should know what interest rates are. Interest rates are basically given to the overall economy and giving from the central bank to the banks. All right, and so interest rates govern the speed at which an economy grows, really. All right, there's a lot of variables, but they really use interest rates as a governor. All right, whether they want the economy to grow fast or slow. And if we head over, let's go to the money section here inside of trading economics, and we can go right to the interest rate. But if your interest rates are high, then guess what? Money is expensive. If interest rates are low, then money is cheap. Right? And this economy is built on debt, right? All the dollars you guys have in your pockets, hopefully Benjamins, okay? Hopefully you got Benjamins in your pocket, but all of those, that's debt. That's an IOU, all right? And so basically, if you want to loan out those Benjamins, then guess what? You're going to be receiving an interest payment. How do you loan out those Benjamins? You do that in the form of a bond. But if you want to borrow those Benjamins to maybe buy a house, buy a car, your interest rate is going to go up depending on what the central bank, the FOMC, okay, what these guys basically want to put in place to help, again, govern the economy. So what you guys can see here, this is the U.S. Interest rate. What you guys will notice is, what do you see? In 2015, we started marching higher and higher and higher. We had an amazing economic growth in the U.S. economy from 2015 all the way up until COVID, and then obviously we sold off massively. Even in 2008, what do you guys see? Right before the crash in 2008, interest rates piling to the upside. They were trying to slow down economic growth to avoid bubbles and things of that sort. It didn't work out in 08, obviously. You guys definitely want to stay up on interest rates. They're probably the most important economic indicator for Forex. Right? They really are. They govern a lot of price movement, okay? And so you want to stay up on the monetary policy for each currency that you're going to be trading, whether it's the British pound, whether it's the Aussie dollar, whether it's the Japanese yen, and you want to know the interest rates. You want to understand negative interest rate territory. Again, there's a lot to learn, but this is something that, again, we talk about inside of the Top Trader Bootcamp. If you guys just want quick resource to understand all of this information, you can apply for that. But outside of that, if you don't have a real critical idea as to what the monetary policy is and how to keep up on that, it's going to hurt your trading dramatically. All right. Here's an amazing example. I'll go quickly. So if we head over to the US dollar here, all right, I want you guys to take a look at something, and I want you to guess what has driven the single largest price moves in the history of the dollar in the past few years. Okay, this massive price move that you guys see happening right here in 2014 all the way up into 2016, what do you think did that? Right, it wasn't a trend line break, it wasn't a candlestick pattern. All right, so the largest price moves that happen in currency trading, in stock trading and crypto trading, are happening because of fundamentals. Okay, the reason this massive move happened on the US dollar was because we decided to stop the QE policy and start to raise interest rates. And right before they started to raise their first interest rates, you saw a lot of demand coming into the dollar because people wanted to get ahead of the trade. All right, so interest rates, very important. Jerome Powell, right now, he's the head of the Fed. Make sure you stay up on what he's doing from a monetary policy perspective, because it's going to give you a tremendous amount of insight. All right, so there's a couple of things we didn't talk about in this video. All right, and again, not all fundamental analysis is on the economic calendar. There's things like presidential consensus. Where does the president think that he wants to go with the economy? How strong does he want the dollar? Is he going to cut taxes? Is he going to raise taxes? That's going to affect the dollar. Trade policy. What does it look like trade war wise with China? All right, Australia and China and New Zealand, they're massive trade partners. That's a trade that we just finished capitalizing on. That affected the currency massively. War in general affects a currency massively. So if you ever see anything happening in that capacity, there's opportunities there. Commodity prices. In the oil markets, you want to make sure that you're staying up on what's happening in that Canadian dollar, right? Canada has a tremendous amount of its GDP tied to oil, okay? So fundamentals are extremely important. Make sure you guys are doing your research on a weekly basis at least. There's always something coming out relative to fundamentals, so there's many trading opportunities. Many people think that when you trade fundamentals, you don't get a lot of trading opportunities. You gotta wait on stuff like Brexit or the recession. It's totally not true, okay? There's trading opportunities every week with fundamentals. We're gonna be coming to you guys guys more with different opportunities that we see popping up. Make sure you guys subscribe if this video helped you. Please like the video, share it with some of your friends who are starting to realize that, hey, technicals aren't the only way to really make this happen. Technicals probably aren't the way you really need to make this happen, especially if you guys are learning simple stuff like, support and resistance and price action. I mean, that's so vague. These markets are moving for reasons, and you need to understand why, and that's why fundamentals are so important. Every institution, no matter where you go, is trading fundamentals. Any bank you walk into, any hedge fund you walk into, any investment firm you walk into, they want to know what's happening in the economy so they can make better trading decisions. You need to trade the exact same way. All right, so I'm Cleveland Bishop. If you guys have any questions for me, post the comments down below. I'll talk to you guys soon. All right, peace out.